Thank you, Anshik. Nice introduction. Thank you so much for the time. And I welcome all of you. Wonderful to see a lot of people joining in today, and I hope I have more people joining in. And just to set the context right, I mean, it's a Friday. We are all in the mood to go back home, or we are already at home, not in the mood to listen. But finances itself is a little kind of a boring topic, but I'll try to make it as fun, as knowledgeable in the next 45 minutes or so. Mohit and I have worked on this, so we hope we will be able to clarify most of your doubts about investing. Now, one request to all of you is that you please feel free to ask us questions at any given point in time. Keep a type in, and the chat box should be, I hope, overloaded with a lot of questions. We will try and answer almost all the questions as much as possible. So over to Mohit to set the agenda for this meeting.
Thank you, firstly, Anshik, for giving us a good introduction. Thanks, Anand, for setting it up. I'll just go on to the slides and give the agenda for today's meeting. So the first thing which we wanted to discuss is with respect to the cash flow planning of anyone. Okay, so we have created a wealth planner Excel model which helps people understand that how their finances are going to move on a year-on-year basis. Okay, so that's an Excel demo which I'll give a brief on. The next thing is on the rules of finance. So you must have done a lot of Google search in terms of there are several rules of finance. Okay, so what is the true relevance of specific finance rules? So speaking on that front, next thing is planning your investments via various asset classes. What are the horizon you need to keep before making a judgment on it? The next is the most important philosophy of investing and how to create a money mindset. So which is a base for how you plan your investments. The next thing is with respect to going forward investment outlook, how you should be planning your investments based on how do you see India growing in the next decade kind of a thing. The last thing, as we are heading into the last week of tax planning scenario, just having a brief onto what kind of investments will be favorable for your tax planning purposes. So that's the agenda of today. And as Anand said, feel free to keep on asking questions in the chat box so that we can have a last 15-minute kind of a session where we are answering most of it. Moving on to the next slide. The first thing is what we want to discuss is the wealth planner demo. So before showing that Excel which we had created for helping you plan your wealth journey, I will have a few questions which will be there as part of the poll right now. I would just ask Anshik to people can vote on those.
Sure, Mohit. I'm sharing the poll right now.
So I would request everyone to go onto this polls segment and just click on the answers which are relevant to you. So those are basic financial planning related questions, which will help us understand where this cohort where we are speaking right now has some kind of a planning done toward those specific finance related topics.
I think the poll is already live. I would request.
Yeah, okay. So the poll is already live, guys. So you can start polling. We'll give you like 2 to 3 minutes to help give those answers. And we can just project it in terms of seeing as to how the answers are coming.
We need more responses, We just have 14 as of now. Yeah, I hope everyone has already voted, for their questions. I already see that 60% have already voted for the questions out there.
Correct. Let's give another minute for every one of you to help those votes. So we have reached already 45 responses. Let's just take another 30 seconds and we can just look into those answers.
Great to see, a lot of people answering these questions.
Great. I guess we have reached something around 80% participation on the poll question, which is a good number to look into. So I'll just quickly read out those questions, and then I'll tell you that why are these questions very relevant for each one of us, right? So the first question was, have you assessed your wealth trajectory? How does it look like from today until the retirement? Okay. So because everyone asks, when do I need to retire? Can I retire very early? But have you ever planned as to how does your wealth trajectory actually looks like, and how many years post retirement you might have to sustain yourself? So I see that almost 69% of people have mentioned that they have not looked into this wealth trajectory as of now, and 25 have tried, but not been able to completely get into it. The next question was, have you planned your financial goals? Now, that is a very important question because a lot of your wealth planning is done around your financial goals, like buying a house, buying a car, means having a child's higher education kind of a thing. But here also I see something around 84% of people are on the no or not completely side. Okay. The next question was with respect to how much is your investment into the equity segment? Well, I'm happy to see that at least 36% of people have mentioned that they at least have that kind of a equity segment in their portfolio. I am assured for the fact that these might be people from the age of 20 to at least 35 who have these kind of a allocation in the equity portfolio. The next question was with respect to, have you assessed your spending and your saving? How does it look like from next 5 to 10 years point of view? Another something around 80% people have mentioned that they don't know exactly how much is the percentage of savings they need to do, because that is the much more important part. As to if you identify how much is the savings to be done, that is when you decide that this is the investment which is going to do, and that is how your wealth journey looks like. The next thing was with respect to how much do you have with respect to your emergency fund. So I'm happy to see that at least 50% top have emergency fund. But the much more important question would be, how much is this emergency fund? Is it to the extent of 3 months, 5 months, 6 months, or a year kind of a salary which they have currently? So 55% as to how much have they done. The next thing is means that's a deal breaker kind of thing. How many of you have been able to create an alpha on the portfolio? So I don't know how have you assessed it in terms of whether you have not done it or tried to manage it. But alpha is basically, if the benchmark return is, let's say 10%, am I able to get 12%, 13%, something over and above the index rates? So that is the alpha which we were speaking about. But as I see, almost 97% of the people have not been able to beat the benchmarks. So that's a very concerning thing because that should be the norm of the day, that you are able to beat the benchmarks. The last question was, have you taken sufficient medical insurance and term insurance to take care of your financial cash flows? Now, that's the much more important thing. Even if you have a very great wealth journey, you're reaching 100, 200 crores, but if you don't have a medical cover or a term cover, and considering PASCAR community, where we speak about medical insurances and all, but I still see that 66% of people have not taken it, or it's not sufficient enough. So that's a very concerning thing. My first thing would be, you should have a term insurance and medical insurance in your portfolio. So that is a much more important part of your portfolio.
This is a good business thing for PASCAR.
Yeah, it's a good, Anshik should take this forward with the management and saying that we still have people who are not into this medical insurance thing. Let's get them covered.
We'll definitely do it. Thanks a lot.
So, I guess that's a good polling session which we had right now, and a good number of responses. 85% of people have responded right now. Now I'll quickly move on to the Excel demo which we wanted to show. I'm just sharing my screen. Okay, that's an Excel which I wanted to show, which we have created. So let me know if the screen is visible to you guys. Is it visible, Anand,
Yes.
Anshik?
Yes, it's visible to us.
Okay, great. So just to give a brief as to what is this Excel about. So this Excel, which me and Anand had thought about in terms of how do we manage our client's portfolio. Okay, now we know that how much where the portfolio has to be gone, right? Where it has to be allocated. But the much more important question is, how much is the savings to be done today? Okay, so it's not like हम 30,000 कर देते. But it's like, how do I identify that 30,000 is the saving which you need to do right away? So mapping the entire demographic profile of a client, understanding what is his age, when does he want to retire, what is his current earnings, what is his investment philosophy, whether he wants to have an allocation higher towards the equity portfolio, considering his age profile, where is he mapped until the age of 45, 50 kind of thing, and post 50, how much conservative is going and having a higher allocation in the debt portfolio. So two philosophies until the age of 45, post 45. Next thing is, what is his current monthly expenses and what are his annual expenses like travel expenses, insurance expenses, one-off expenses, festive expenses. What is the total expenses which is incurring right away in the current year? Based on that, how much is the savings he's actually going to make? So these are the basic information which you took, but we also had a few estimates that how much is the increment going to be year on year kind of a thing, how much is the expenses going to increase, which we have modeled it up into this Excel. And we have done this Excel using a pilot on at least 40 to 45 people, having various demographic profiles at the age of 25 to 45 to 55, understanding what are the expenses they do on a year-on-year basis at various brackets of their lives and various standard of living also. So we have modeled it up in terms of what are the estimated expenses as and when you keep on growing. Those are the basic things which we have cumulated, mapped it up with a further thing of financial goals. At what age in life you want to incur specific financial goals. So let's say this is a person who's Rahul, who was age 25. I'll just show it again. Age 25, retirement age is 55. He has a current earnings of 12 lakh rupees. He has a very aggressive portfolio where he has an equity mix of 90%, debt mix of 10% until the age of 45, because he has an earning capability. So hence he's going to take a risk. The next thing is post 45, he wants to reduce his equity allocation and get it to 60%, have a debt portfolio of 40%. He has a current monthly expense of 38,000 and an annual saving of 6,82,000, which means 56,000 of current savings. So that means this is the saving which he has availed for getting into the portfolio and of an allocation. The next thing what we mapped is the financial goals. So at the age of 30, he wants to have a car of, let's say, 10 lakh rupees. So every expenses which I have mapped it out here is on PV basis, present value basis, and catching up with the inflation which has been modeled into the portfolio. The next thing which he wanted to do is his marriage at the age of 30, where he wants to spend on from his own portfolio 10 lakh rupees. The next thing is a house at 35 when he wants to spend 1 crore kind of an investment. Second car he wants to have at the age of 40. Second house at the age of 55, another 2 crores which he wants to spend. Child's higher education, which is MBA or master's kind of a scenario. At the age of 55, he expects his first child to spend something around 35 lakhs. And the next child, he has another car at the age of 50. And the second education of his second child at the age of 60, where he is again going to spend something around 35 lakhs. And post that, his last financial goals are with respect to his child marriages, where he's going to spend something around 20 lakhs each. So those are the financial goals which I mapped it up for Rahul. Post that, we were at least able to map out what is his per year. Let's say if he's earning 100 rupees, what is the split between that 100 rupees in terms of what is the savings he needs to do, how much is the expense he needs to do. When we do a financial planning, we say that these are my expenses, this is how much I'm going to save. So this model helps you understand that while we know how much you're going to spend, these are the savings which you need to do. So as soon as you get 100 rupees, 59 is the number which you need to save it right away and invest into the specific portfolio philosophy which you thought about. So this Excel helps you, this dashboard helps you understand that of that 100 rupees, what do I need to do? The final thing of Rahul is, what we did is mapped his wealth trajectory as to at each 5-year intervals, how his wealth is going to grow from 8 lakhs at the age of 25, where he's going to retire at the age of 55. He has a portfolio of 34 crores in his 34 crores portfolio. And once he retires, he's been able to grow his portfolio to the extent of 100 crores at the age of 70. So it's like telling that 100 crores portfolio which he has, obviously it will have an inflation impact, and that 100 crores is valued at 10 crores on a PV basis. But this is after all his expenditures which he has incurred for on a recurring basis for his house running expenses, his shopping expenses, his financial goal which we just spoke about. So this is how his wealth trajectory actually looks like. Now, compared to Rahul, I'll show you another person who's Kabir, and I'll share my screen, next screen, where I'll show you as to how much his earnings going to be when he changes a few parameters. Just let me know when you can see my screen. Yeah, I guess my screen is visible now. So the highlight which I have made is basically showing that where is Kabir different from Rahul? While his other parameters are the same, age 25, retirement age 55, current earnings 12 lakhs. His current expenses are also the same and his savings also the same. But the things he has changed is his equity allocation. At the age of 25 until his 45 age, he has a lower equity allocation. He's not a risk-taking person. So he has a 70% currently and a 30% in the debt, and he goes much more conservative post 45, which is a 40% allocation compared to Rahul's 60% allocation. The next thing which he did was he had the similar financial goal at a similar expenditure, but just the timings were very different for him. The second house which Rahul had at the age of 55, Kabir wanted to have it at 50. His child education, which was at 55 for Rahul, he had a postponement of Kabir at the age of 58. Child marriage and his second car, while Rahul had at a very later age, Kabir had it preponed. So when these things change in your life, when you have a different financial goal in terms of your timing, how much is your financial journey going to change? Now, this is the expenditure matrix which we showed in compared to Rahul. While Rahul had a lower savings rate towards the end, Kabir has a lower savings rate in between itself. Because if you are saving less in the initial periods of your life, the wealth journey is going to be very different. And the next slide which I show you is where Kabir is going to reach at his age of 55 and post-retirement at the age of 70. Now, if you see, they started off at the same number of 8 lakh rupees, but at the age of 55, while Rahul had a number of 35 crores, he has 22 crores. Kabir has 22 crores, but at the age of 70, he ended up with 27 crores only because of few matrix which has changed, specifically on the investment philosophy. And the second thing was with respect to his timing of financial growth. So the point being, this Excel helps you understand that how is your savings going to be, how are expenses going to increase, when are you going to time your financial goals, and how does your wealth trajectory actually look like? Are there going to be dips in between? Are you not able to sustain your expenses? Are you not able to sustain your financial goals? Or you have overachieved kind of a thing? It also tells you that how much proactiveness you need to take on your career also. Let's say if you are at a 12 lakh kind of earning, do you need to have another hike of something? Means you switch from one company to another, taking a hike by, let's say, 20%. These are like the proactive measures which you need to take in terms of seeing that where does your wealth journey actually goes towards. So I'll quickly go on to the PDF right now. So this is the dashboard which actually looks like in terms of whenever we interact with our clients, we test their entire health profile, the financial health profile in this Excel, giving them this dashboard, helping them to understand what are the matrices you have to look upon. And these Excels might be very dynamic in nature going forward because your earning profiles might change, your expenses patterns might change. So that is when we always have an interaction with our clients, if and when these numbers are going to change for them. So this is like a dashboard which we give it to our clients so that it's a base for them to understand and take actions for their portfolio.
Great, Mohit. So, I mean, when I mean Excel, this is a one-on-one session we do with investors. Here, we thought we'll just tell you what is so this wealth school is nothing but a journey where it's an idea where I thought, I've been working for 19 years now, managing a lot of investors' money and all that stuff, and grown their portfolio. So why can't we do the same at a very young age for people who are maybe 25 years old, maybe 30 years old, maybe 35 years old, right? So that is what this wealth Excel or wealth school is all about, where we project your wealth journey, estimate your savings, expense trajectory, also build a very important investment philosophy around how do you do things, when do you time your financial goals, be very proactive when it comes to earnings and investing. So there are a lot of things that we do, and this is a cohort that we have tried to build about 100 people for 100 crore kind of a corpus. The best thing is we help you to execute the entire plan. It's not just about coming and saying, "Arey, it's 10 cheez kar lo, aapka sab kuch theek ho jayega." We also help you throughout the journey, handle you throughout the journey. So a lot of people have asked me, "Do you have this? Will you have an access to this Excel sheet?" No, you will not have an access to this Excel sheet. What you need to do is, in fact, we charge for one-on-one session, but for Pasca, what we have done is, I think we should just waive off the charges, Mohit. So Mohit, if you could just share your calendar link, okay? So for those people who want to do this session, okay, of projecting their wealth journey, they can just click on the link and schedule a one-on-one session with you. Maybe for the first 10 people who are, or 15 people who are going to register, maybe we'll do it there. Just mention that you heard about us from Pascal, guys. Okay, so just quickly register yourself, click on the link, and then it's already there. Click on that link and block the calendar with Mohit. It will be a 30-minute session, can get extended also, but it will be a good informative session. Plus, we will also help you execute. It's not just about planning. Execution mein aur bhi zyada time lagta hai. We help you to do that also. Yeah. So we are Mohit, we have to be a little faster. We are already at 25 minutes. So we just go to the next.
So the next segment is with respect to the rules of finance. And I'll quickly run through these rules of finance, because most of them, which you see, are not very true to yourself, right? Like the rule of 100, or now which is 120. It says that 100 minus your age should be your equity allocation. Now, this might be a benchmark for some people, but everyone's finances are very different from, risk appetite is very different from one another, right? So it depends on your earning capabilities, market volatility, sustainability of income. That plays a major role in determining what should be your equity and debt allocation. So while this might be a rule of life, but it cannot be applied to each one of us. The next thing was with respect to spends and saving allocation, 50-30-20 rule, which says that 50% of your money should go towards your needs, 30% towards your wants, and 20% your savings. But what is the relevance of this number? Do you think that this can be a benchmark for your life? Do you think that spending first is better than saving later, or saving first is better than spending later? That has to be determined in terms of identifying that what should be your saving percentages. The next thing is with respect to the 10% rule, which says that 10% of your earnings, of your today's earnings, should be saved towards a retirement. But do you even know that how much do you require at when you retire? When are you going to retire is another question which you need to have, because suppose that how much money you will be needing, what is your standard of living, that determines that whether your retirement pool is going to be good enough or not. Then last thing was with respect to the 4% rule, where it says that once you reach your retirement, every year you need to have 4% of your retirement pool or your portfolio towards your expenses of your life. While I did this same mathematics on my portfolio also on this Wealth Excel, I somehow came across that it's like 2% to 3% is good enough for spending those numbers once you retire. So those are the benchmarks, which is very different from one another. While these are non-relatable financial rules, few of the rules which are very relatable to you is the rule of 72 or 114, which tells you how many years does it take for your portfolio to double or treble. Now, how will this help you understand that what is your risk appetite and when do you need to time your financial goals? So that is how you will identify that what kind of a profile I need to get into. If I'm having a portfolio in, let's say, FD kind of a portfolio, which gives you 5% return, 72 divided by 5 will tell you that it will take you something around 15 to 16 years to double your portfolio. 15 to 16, yeah, something around that, to double your portfolio. Can you wait until that time because your financial goal might be coming into between? So those are the things which help you understand that what kind of a risk appetite you need to have. The next thing is with respect to the emergency fund, which is 3 to 6 months of salary cover. Why is this important? Because there might be uncertainty with respect to your job breaks or irregular income when you are a self-employed or a freelance worker. There might be irregular one-off expenses which you might have in life, which you will not be able to spend from your salary. Hence, you need to have an emergency fund. There might be medical emergencies also, where your medical insurance is not able to cover yourself, and if it is not sufficient enough. So how do you create these emergency funds? From an initial salary, you need to start parking some funds towards your emergency fund. Once you start utilizing to an extent, You just need to refill from your upcoming salaries. And as and when your earnings increase, you just need to increase that by that percentage with your how much is your earnings going to increase. So that is how you always keep up with your emergency funds. The next thing is with respect to the term insurance, which says that 10 to 20x of your cover, means of your salary, should be your annual salary, should be your term insurance cover. Now, insurance company might give you till 25x, but is that really important for you is something which you need to decide. And how do you decide it? Basically is based on your next 10 to 15 years of expenses of your on a PV basis. That can help you understand that if something happens to me tomorrow, at least my 10-15 years of expenses are covered for my family who's left behind. You need to increase your cover. Now, this might not be a benchmark of life, but you should ideally increase your insurance cover by after every 5 to 7 years, as in where your income keeps on increasing. You should. I recently had a poll on LinkedIn where I asked this question that when is till what time have you covered your term insurance? Is it until your retirement? Is it until your last financial goal? So most of them said that it's beyond these two. So I'm shocked to see that a lot of people have covered it beyond that. But the question is, do you require it post that also? Are you sufficient enough until your last financial goal enough? The next thing is term insurance. You should start very early because obviously the insurance premium would be very lower, but you're immediately as soon as you started to earn, you are covered yourself and your family by it. And means I have a feeling that term insurance is much more important than your guaranteed benefit policies. So my recommendation would always be that have a term insurance because you don't need to have a return out of your insurance. It's just a cover which you need to purely have in your portfolio. The next rule is with respect to the Avalanche method. It basically says that if the rates are down currently, if the interest rates are down, you should not ideally prepay your loans unless you have an excess balance available. If you have it, you can do it. But if it's a lower rate scenario, you should keep on paying your EMIs. Once the interest rate goes above some limits, you should then prepay your loan. The next thing was with respect to first year salary rule. Whenever you take a student education loan, you should just keep in mind that whatever the loan you're going to take is your first year salary of that student. Is that going to be sufficient enough to cover the amount of loan? I'm not saying you have to pay the loan, but is it going to be enough? Because that will help you understand that whether you are getting into affordability affordable college or not. The last thing is with respect to the inflation, which is a very big termite in anyone's life. It basically says that 70 divided by the current inflation rate will help you understand that how many years will it take your money to go half. So basically 70 divided by 6%, which is the current inflation rate, somewhere about 5.6% right now. It says that in next 12 years, your 100 rupees today will be worth 50 rupees. So these are the few rules of life which can be relatable to a specific person, while the before one, which I said, is very different from person to person. However, I guess these are the principles which are very universal in nature, which everyone should keep in mind. Those are saying that start saving and start small. It doesn't matter how much do you need to save more than what you need to do, but it should be that you need to start saving. You need to determine your risk profile. Where do you fall? Grow your savings through your investments. That is a much more important thing. You need to time your financial goals, because that is when you determine that where is your wealth journey going to be. You got to maintain patience, because as Anand said in the starting, investment can be boring. You got to have that patience always, whether there are volatilities in the market or not. It also depends what kind of risk profile you have. Where are your investments going to be? Is that in crypto? Is it in trading markets? Or is it in a long-term horizon kind of a thing? You got to monitor your portfolio, which is a much more important thing, because if you're not monitoring the portfolio, you're basically cursing your portfolio to that extent. Whatever it grows, I'm okay with it. Okay, so monitoring is much more important. But if you're not able to give time to your portfolio, you should at least have someone who's looking into your portfolio, so that the returns are at least up to date with how the benchmarks are performing. And the last and the most important thing is always be insured, because no matter what you plan, if you're not insured, the numbers can go on a toss. So those are the rules of finance, which I thought will be very helpful for anyone understanding this thing. I'm going on to the next segment now, which is with respect to planning your investments based on asset classes and the importance of horizon, which you need to have in mind. Over to you, Anand.
So primarily, there are two things that should matter when it comes to how do we determine how to invest, where to invest, how much to invest. What I thought was I'll just touch base upon various asset classes. I'm sure a lot of people know equity, which is stocks, listed stocks. I don't know how many of you know that there is also something called unlisted stocks, where you can buy companies which are getting into an IPO before getting into an IPO itself. For example, Chennai Super Kings or HDFC Securities or Reliance Retail kind of companies. These shares are available in the unlisted markets. In the equity space, you have mutual funds, you have managed equity, where people, well, you can give your money to a registered investment advisor who will manage it for you. And then there is something called angel investing. These days, a lot of democratizing of angel is happening. So you can participate or invest in in startups with as low as 5,000-10,000 rupees also. So this is one asset class. Debt is nothing but what your fixed deposit.
Very good evening, Shalini this side.
Yeah, sorry, I think it's okay. So the debt is, where you have short-term, medium-term debt, FDs. You can invest for a short period. You can invest for a long period. You can invest for a medium-term period. Then comes commodities. In India today, you can invest in gold, silver, crude oil via futures, but no more. I think over the next few years, you will be able to invest in crude oil directly also. Real estate, for example, if you want to invest in real estate, while you can buy physical real estate, which is pretty large investment to make, you can in fact go via real estate investment trust, where you can own a small piece or a small unit of a rental income property, like tech parks and stuff like that. There are a few REITs that are available these days. Are also, let's say, if you want to generate rental income, but let's say you can actually buy a large piece of commercial property where the rental comes to you directly, but you don't have to own that completely. You can own it among with other investors. So the investment levels are high, but you make about 8-9% kind of a rental income also in the real estate space. And finally, international investing. As you can see, you can invest in global indexes. Today, you have NASDAQ funds, you have S&P 500 funds, you have all equity funds from US. There are so many indexes funds. Plus, there are Brazil funds, there are China fund, there is EASM, Emerging Europe fund. There are lots of funds. So today, there are various asset classes and various funds with which you can actually go and plan your investments. Quickly, we'll move to the thing that is most important, is duration. If you could just see the. So what matters when it comes to investment plan is what is your age? Okay, how far is your financial goal? Is it tomorrow? Is it after a year? Is it after 3 years? Is it after, whether you want to buy a car tomorrow, you want to buy a home in the next 3 years, you have a kid who's going to college in the next 15 years, you want to retire in the next 30 years. So there are time horizon matters. Where is your financial goal? That matters. What is your risk profile? See, today everyone quotes Warren Buffett. Today everyone quotes ki usne ye bol diya, Rakesh Jhunjhunwala ne ye bol diya ki buy and hold is the best strategy and all that stuff. Please understand, every individual is different. What suits me may not suit you. So we need to know what is your risk profile. Everyone knows that equity makes big money. If you see the chart here, equity makes big money over a longer period of time. But for all you know, you don't want to get into equity because you don't have the risk appetite. Everyone knows that FD is not a great instrument to make because it gives only 6% and inflation is 6%. So net, you're not making any investment return by putting your money in FD. But boss, that is how I am. I don't want to take risk in my portfolio. Right? So every individual is different, and that's the reason why every investment plan is different. What suits you may not really suit to the guy who's sitting next to you. What suits you may not suit to me, and it differs from people to people. And that's the reason why, while Mohit was telling you about those blanket rules, I respect them. I may not really agree to all of them, right? And the last point is your financial goal immediate? When I mean immediate, the kind of money that you need, is it going to be immediate or is it going to be over a period of time? So for example, let's say if you want to buy a car, you have to put the down payment immediately. If you want to send your son or daughter, I mean, I don't know how many people are married here, but let's say if you're assuming that you're married, you have a son who's going to school or college, and you have to pay the fee in 4 installments. That is tenured. Or if you're retiring and you're retiring at the age of 55, you need the money for the next 30 years, assuming that you live for 85 years. So that is called tenure. So all these are important part before you can actually create an investment plan. And if you see on the right hand side, I have plotted returns versus risk. The higher the risk you take, when I mean risk, it doesn't mean that loss of capital. It is just that it's going to be a little more volatile. FD to straight line में जाएगा, but return नहीं मिलेगा. Equity ऊपर नीचे जाएगा, but return अच्छा मिलेगा. If you go and invest into a startup, for all you know, you may lose all your money, but for all you know, you make 100x returns also. So risk is higher. The higher the risk, the higher the return is generally. And if you want to reduce the risk in any portfolio, in any good portfolio, all you have to do is have time by your side. The longer the time you have, the better it is. The risk comes down over a period of time. I've just made it very quick. Next slide, Mohit. Please keep asking questions, guys. Yeah. So if you see what is asset allocation, everybody today talks about asset allocation. If you go to YouTube, type in asset allocation, you'll get some 1,000 videos talking about asset allocation. It is nothing but a way in which you're diversifying your portfolio. In equity, if you just put all your money in equity, if you had put it in January, today your portfolio is down 5, 7, 10, 15% or so. If you had put the money in January in two different assets, one is equity, 50%, debt, 50%, your portfolio is down only 4, 5%. That is called diversification. You use those asset classes that I mentioned, equity, debt, commodity, currency, a lot of things to create a portfolio that may not really be impacted all the time, but will not also go through a period of lot of volatility. It will be a lot more stable. Because if you see this graph, if you see this box, right? If you see in different zones, sometimes gold has done well, sometimes GSEC is government security, has done well. Sometimes credit risk is nothing but a debt fund has done well. Sometimes, most of the times, equity has done well. So you need to put your money not just in equity. That's a problem that a lot of investors who are getting into the investing right now, doing everything, put it in the stock market. Aise nahi hona chahiye. Plan it out, do the right asset allocation, match it to your risk profile. 80% goes to equity, 20% goes to debt. 70% goes to equity, 20% goes to debt, 10% goes to gold. For all you know, that is what an investment planner for you should do. That is what Mohit should do. That is what I should do. And this is a chart, this particular screen can actually clearly say the reason why you should diversify across various asset classes. Hope you got this point. You can ask me questions later on this also. This is my favorite topic. I have a YouTube channel called Rathi. I am on LinkedIn also. I talk about money mindset. Everybody makes money. You're here, you're working in a good company, earning good salaries, you will make a lot of money. Okay. You will also get good advice. Let's say Mohit and I will come and say, great, you put the money in XYZ mutual fund, the mutual fund doubles. It has happened many times, right? But the question is, what do you do after it doubles? You need to create the right money mindset. The double, just because it is double, people actually exit that fund or exit that stock. That's not how it should be. It has to be held on for a longer period of time, where you help the power of compounding to kick in. You have to create the right money mindset. The ability to hold on to profit is the reason why the legendary investors are called legends. The ability not able to, our inability to hold on profits is the reason why we are not called legends yet. For all you know, you may be, but at least I am not called a legend yet, because मैंने एक stock लिया, it went up by 400%, but I sold it off, only to realize that I went up another 400%, which is 16 times, right? We need to create a right money mindset, and that is all my effort in my YouTube channel and also in my LinkedIn and wherever other platforms that I am on. So there are certain beliefs, very simple beliefs. One belief which I stick to is not investing in equity is risky. Not investing. I'm not saying about investing. अगर आप equity में पैसा नहीं डाल रहे हो, if it is a medium to long term goal, it is risky. Your portfolio is under risk. Everyone thinks I can enter and exit at the right time. Timing only happens twice. Either you're a god. I mean, you can get your timing correct only if you're two of them. One, either you're God. Two, you're a liar. यही दो लोग timing correct कर सकते हैं. बाकी कोई भी timing correct नहीं कर सकता. You can bring in tens of charts, technical charts, fundamental charts. Nobody can time the market. What matters is time in the market, right? Be in the market. You go through ups and downs. Be in the market. You will generate wealth. In the longer run, fundamentals replace emotions. Russia, Ukraine, sometime back. I mean, now COVID, sometime back. Usse pehle GST, usse pehle notebandi, usse pehle GFC. Lot of emotional things will happen. You don't have to worry about that. In the longer run, if you have a good portfolio, fundamental of the portfolio is what will drive your returns. It is very simple. Don't let your short-term performance determine your decision on asset allocation. Buy and hold is not the right strategy. I've come under a lot of flack for this. Everyone says Warren Buffett ने Coca-Cola लिया, उन्होंने अभी तक मतलब 50 साल हो गया. He continues to hold that. Because nobody talks about his IBM. He bought it and sold it off in 5 years. That is because IBM was not executing as per the plan. So buy, hold, and watch, or buy, hold, and exit if the company is not going good is the right plan. Don't be shy of exiting if the particular asset that you've invested in is not doing good. Finally, inflation is the dimak, is a termite. It'll keep eating your money. Okay, the solution to that is compound. Let your money grow and grow and grow. It will automatically eat away your inflation, right? So these are our beliefs. More on this, I mean, I can keep talking about it. It's a topic of my interest, but we are running short on time. So Mohit, you can take the next sessions. Okay, I'll take this again. So what do we think India is, where is India going to be? I'll keep it very short. We are, everyone, you're young. You guys are all young. You're all millennials. We have favorable demographic, right? There is a lot of transformation happening. Next slide, please. I'll just give you a simple calculation. In the last few years, India, so there is something called GDP, gross domestic product. There is something called nominal GDP, which is nothing but India's growth rate, which is real GDP plus inflation. In the past 5 years and 10-year period, India on an average has grown by 13 to 15% kind of a GDP. Okay. So if you were to extrapolate that, these are the kind of equity returns that you can make. Let's say if India grows at 12%, your money should be, India should reach $10 trillion, or India should be 4x the size in 13.5 years. If we grow at 15%, India itself will be at 10x, India itself will be at 4 times in 10 years. If India can be 4 times, where we have got so many states, so many people talking about, if you invest in good company, those guys will be at a far better growth rate. So you should be a little more greedy at this point in time while investing in India for the longer run. Don't ask me, मैंने आज डाला एक साल में मेरा पैसा ये नहीं हुआ. Don't ask me that. But in the longer run, you will see great returns from India because of a lot of things working very well for India. Yeah, this I've already spoken about. So these are the kind of investment. You invest 100 rupees today, and if your portfolio grows at 15%, you should have 4 times 405 rupees at the end of 10 years. If it by chance grows at 20%, very difficult to be honest. Let's assume grow kar bhi diya. Your portfolio should be 6 times in 10 years. 6 times. Got it? Right.
Thank you, Anand, for that. I'll just take up the next session with respect to tax-based investing, because we are in the last week of the tax filings. So just giving you a broad theme as to what are the ideal investments to be done from a tax point of view. So I've just noted ATC deductions, which are largely, which has the investment planning kind of a thing. The first thing is with respect to ELSS funds. Okay, so that have a lock-in of 3 years. However, it gives you an exposure into the equity segment. So if you are starting early and you have to have a tax expo, means you have to have a tax saving instrument in your portfolio, it's better that you start off with the ELSS fund, because it brings you into this equity space. And since, as we spoke right now, you've got to be a bit bullish on the equity segment in your portfolio. This gives you a chance of having a equity straight away into your portfolio. And then you can see as to how does your risk profile seems like. Also, just wanted to mention out that since with respect to tax planning, we usually end up investing in the month of March. I recently done an analysis, an Excel analysis as to whether March-based investing into ELSS fund is an expensive one or not. It turns out that expensive for you. So the better route is to take a SIP, start your FY23 investment planning, tax planning from April, do a ELSS SIP kind of an investment. Because March investing can be expensive to the extent of 2% at least, which are done on a 10-year investment basis. So one is on the ELSS fund. Next is Public Provident Fund, which is the PPF. The current rate is 7.1% right now. It is a debt exposure which you take. It's a favorable investment option because it is entirely tax-free. the proceeds, the interest on your maturity, and the withdrawal which you make during the period post 5 years of the lock-in period which it has, it's entirely tax-free. So it gives you a tax base at least from all the three sides. Like you get a tax saving right now, you get a tax saving when you have the interest accumulated in your portfolio. So that's a better way of investing into public provident fund. Now, provident fund, which you have is your employee provident fund. It's automatically deducted from your portfolio or from your salary. So that might be a hindrance to you because it's like taking away cash from in-hand cash from you. However, there are few restrictions in terms of the lock-in is until the age of 58. You can withdraw only for specific things in your life. Let's say if there's a death happening, the family can take it. If it's with respect to wedding or something, medical emergency, then that is when you can take out your provident fund. Also, the proceeds are taxable if withdrawn within 5 years of services. Also, as and when your your salary keeps on growing, your interest is taxable above the 2.5 lakh contributed in your EPF fund. So as and when you go across 30 lakhs, 35 lakhs of salary, your chances of interest your public provident fund kind of a calculation on a year basis might exceed the 2.5 lakh contribution also. So public provident fund is the third thing. The next thing is with respect to Sukanya Samriddhi Yojana. I find it very interesting because that is how the government wanted to promote a girl-child thing in the country. So if anyone who's married and has a girl child, they should actually opt for this scheme because in terms of how the numbers go around, it's also an entirely tax-free kind of a model structure as good as a public provident fund, where you're getting a 7.6% rate as of now. You need to invest on a year-on-year basis, and you can withdraw the fund as and when the girl child crosses 18 years of age or she has completed her 10th standard for meeting her education expenses. So basically, you are investing for your girl child education. So that's a good investment to have in your tax saving instrument in your portfolio. The next thing, the few others are maybe these are tax options, but might not be so favorable enough in terms of at least the lock-in period or the withdrawal limits which they have. Now, National Savings Certificate, it has a 6.8 kind of a return, which is good in a portfolio from a debt point of view, but it has a lock-in of 5 years and interest earned in the 5th year is taxable. Premature withdrawals are not allowed. So that might be a problem with respect to investing into these things because it might have an impact on your cash flow. The 5-year fixed deposit, lock-in for 5 years, premature withdrawals are not allowed and interest is taxable. So no, means compared to the other which we spoke of, public provident fund and Sukanya Samriddhi Yojana, these are not in favor of because your interest is getting taxed out here. 5-year post office is at a 6.7% rate, but the interest earned is again taxable out here. The next few things are not on a investment purposes, but purely the term insurance which you have and also the guaranteed benefit plan you have. The guaranteed benefit plan might have a problem with respect to your surrender value. In case you think that you don't want to continue with the specific fund now, you might have to take a loss into your portfolio. And I've seen it with few of my clients who have been sold LIC kind of plans earlier, but they end up spending a lot for the next 15 more years. It doesn't give you a much more better IRR of just 5 to 6% only. Term insurance, as I spoke before, it's a pure life cover. It's better to have it in your portfolio because it just not gives you that tax saving instrument, but it also gives you a life cover with it. ULIP is something which can be taken a call because it has a market link NAV kind of a thing into the portfolio. It also gives you a life cover, but it has a lock-in period of 5 years. So that might have a problem in your portfolio with respect to cash flow planning. So in all, just to summarize these things, I just thought that I'll give you ideal ATC investment which you need to have. So existing commitment might be with respect to the provident fund which is getting deducted by your company. However, I sometimes recommend my people in my network that if a company is providing you that provident fund is optional, you might take that option because you have better in-hand salary and you can deploy it as per your needs, as per your investment philosophy. The next thing is LIC. If you already have an existing one, so that might be a commitment which you're already doing towards ATC investments. But even after that, if you have some amount available for the ATC, you should first go for ELSS fund because it gives you a step into the equity investments. Next thing is with respect to term insurance, but because it helps you cover yourself, also provide you tax savings. Next is public provident fund because of its tax-free exemption, which it has. and also the 7.1% the rate of interest which is had right now. Sukanya Samriddhi, if you have a girl child, it's a favorable one because you're investing for your girl child, and it also is a tax exempt investment. The last thing is with respect to NPS scheme, which is available to the extent of 50,000 more in the ATCCD 1B section. NPS is a scheme where you can have it has a tier 1, tier 2 kind of a network, where tier 1 is a mandatory thing which you need to have, but the withdrawal limits are very low in that specific scheme. Tier 2 is a optional one where you can invest into it, but you got to have first tier 1 invested into it. So it's available from 18 years to 65 years. It's created for retirement corpus. The withdrawal of 60%, which is tax-free after you achieve 60 years. After that, the remaining 40% is given to an insurance company for your annuity insurance plan, which helps you in the retirement kind of a stage. It invests into equity, corporate debt, government securities, and alternative investments. So there is a choice which you need to give as to how much allocation you need to have in these specific categories. Now, when you see the NPS scheme, the return which they have provided, barring the COVID period, it's a return of 8 to 10%, which you can favorably think from next 20, 30 per years point of view. Depends on how much equity allocations you have. Because initially you can have to the extent of 75% equity allocation, but once you reach 50, it keeps on reducing by 2.5% every year, because government also wants you to be conservative in nature in terms of your NPS scheme. So you can decide your allocation in the above asset classes based on whatever restrictions the government has given into specific asset classes, like alternative.
Looks like he's stuck.
I think, yeah, we lost him in between. No worries. I think
that are favorable ATC investments in your portfolio.
Okay, so Mohit, we lost you a little in between, which is fine. Yeah, you may want to just close it, and there are a couple of questions on taxation you want to answer.
Yeah.
So I'll just take it up with you, Mohit, the questions that we have, right?
Sure.
So Kundan is asking that will investment in Sukanya Yojana be tax-free over and above ATC exemptions?
No, it is to the extent of 1.5 lakhs only.
Okay. Can we avail HRA and home loan interest benefits both?
HRA and?
HRA and home loan interest benefits.
Yeah, home loan, your principal payment is available in ATC, while the interest is available in another section. So you can avail those specific home loan things, but it has to be under your name so that it gets under your income tax profile.
Got it. Next up is, how do debt or debt bond or loan show up in the books? Like, would that be shown in expense or deducted from taxable income, or is it shown in liability?
I'm not sure. With respect to which debt bond you're saying?
So it's just mentioned debt bond or loan show up in the books. How do debt or debt bond or loan show up in the books?
So debt bond is an investment which you're doing. So that's on an asset side, while the loan is a liability. It will be shown on the liability side of your balance sheet.
Okay. Okay.
I mean, if you're salaried, there's no balance sheet, right? So I think there are three things there. Debt bond is an investment. So whatever income you make, and if you realize that the bonds, depending on the tenure that you're holding, you'll be taxed accordingly. On the loans, I don't think there's any kind of a deduction that you get other than what Mohit has mentioned, as far as I know.
Okay. There's one question that we lost in between. I'll just take it up with you. 1 second. Yeah. So it says, is investing in physical gold more helpful or liquid gold or bonds?
Liquid is better. Security is not there. Physical, you have to keep a little bit of a security. When you keep physical gold, there's also you're subject to do wealth taxes also. Some 1% tax or something that is there. So it's better to keep it in liquid.
Okay. Got it.
And one question was there. I mean, I was trying to answer as many questions as possible. Somebody asked me, what is a lifestyle fund? So lifestyle is large cap, mid cap, small cap are the general categories. And then you also go into thematic. Somebody will say, I want to invest in banking fund. Someone will say, I like IT. Let me invest in IT. Lifestyle will be more like a consumption fund where you are betting on consumption revival in India. So you invest in a lifestyle or a consumption fund. That's called, it's like a theme, like an infrastructure is a theme, consumption is a theme, IT is a sectoral theme, or banking is a sectoral theme. It's like a thematic investment, which is a lot more riskier than large cap, mid cap, and small cap investment. Again, when I mean riskier, volatile.
Great. Thanks a lot, Anand. There's one more question that we lost in between. Suppose you have to invest in real estate. Is it good to invest all or take a loan and keep the fund available?
So yeah, I had written that. So see, the thing is, loan is always tricky. Okay, there's never an answer. I've done a video on that. It is never easy to figure out, should I take a loan, should I pay off my loan, or should I keep the loan, right? If you feel that you can generate higher returns, which is not just saying, okay, I took a loan at 7%, I generate 7.5%, let me take the loan. No, it's not like that. If you think that the money that which you have, right, which you're taking as a loan instead, which you already have, is growing at a much faster pace than the loan rate of 7-8% or 6%, then you can go for a loan. Okay, this is one qualitative aspect. I mean quantitative. कि हो गया, मेरा loan rate 7% है, मेरा growth rate 10% है post tax, so let me go for it. But the thing is, there's a qualitative factor of peace of mind that nobody can calculate. So for all you know, by paying off the loan, which is at 6.5%, I am at more at a piece, a metal piece. So for all you know, that is a better option, even if logically you can go for a higher growth rate. So it cannot be answered like a clear black and white. It has to be like a gray. Depends on both qualitative and the quantitative factor.
Understood. There's one more question. How much one should allocate in NPS every year? Exemption is only 50K.
Yeah, to the extent of it's actually to the extent of 2 lakhs in total you can have. So remaining 1.5 lakhs you can do in ATC. There's another section where it gives you 50,000 more. So you can go up till 2 lakhs. But as I mentioned, it has a few problems with respect to how much you can withdraw. So that will be very key in terms of how your cash flow planning is going to be.
Understood. What are the other tax saving options available if you have exhausted ATC, CCD, D, where returns maturity is not taxable?
There is none.
Okay.
No, there's one other option that you can do is become a consultant. Well, because you'll get 50% flat. I think. Yeah. To be honest, I don't think there's anything else.
So salaried people actually have to suffer with respect to the taxation, whatever they have. The other things which they can do is, but those are not investment options, like going for a donation kind of a thing, ATG, AT. Under that, you can do donations and avail few deductions for your income tax. But clearly no investment opportunities otherwise.
Got it. Are there any tax benefits for long-term investments in equity?
ATC.
ATC, okay.
ELSS.
No, for equities. No, for equities he's mentioning. So long-term, can you just repeat, Anshay?
One second. I lost the question. 1 second. Yeah.
Are there any tax
benefits for long-term investments in equity?
So that's only with respect to the 10% equity taxation, which is there on the LTCG thing. But if you're on a short term, you get taxed by 15% rate. But if you go on a long term, you get 10%. So that's the maximum you can get.
Maybe he's asking the question about that 1 lakh exemption on long term.
Oh, maybe that also. Yeah. So basically what it tells that if in a year you have 1 lakh of LTCG gains, right? So to that amount, 1 lakh.
Long-term capital gain.
Yeah, long-term capital gain. So basically, if you have that long-term capital gain in the equity segment to the extent of 1 lakh rupees, that is exempt. But over and above 1 lakh rupees, you will be taxed at a rate of 10%.
Okay. To put it simply, if you have 2 lakhs of capital gain in the by holding equity investment, whether by a mutual funds or directly, right, and you held it for more than a year, you will have to pay only a tax of 10% only on 1 lakh rupees, because 1 lakh is exempted by the government.
Got it. I think we have already answered this one question. We'll just take it up again for Malay. Can we avail HRN home loan interest benefits both?
Yeah.
Okay.
Sorry, once again. Yeah, you can avail both. Somebody has asked me that loan rebate for commercial property. I mean, Mohit.
Will we get loan rebate for commercial property? Actually, I'm not too sure on that commercial property thing. So maybe we can take it up. Suryansh had asked this question, right? Maybe I can help him post the call.
Okay. So Rashmi, I think I've already asked this thing, how to invest in unlisted shares in startups.
Yeah. So startups, there are platforms that are there which help you to invest as low as 5,000 rupees. Tyke is a platform. in startups or in unlisted, for example, companies, as I mentioned, if you see my LinkedIn profile, I mentioned that I'm an early investor in Chennai Super Kings, which is an unlisted firm like Tata Technology, Chennai Super Kings, Reliance Retail, HDFC Securities. There are tons of unlisted companies. For example, what happens is if you're an ESOP holder and if your board approves to sell your shares in the secondary market, not just to them, those are called unlisted shares. And if you really like those shares, we can help you buy those, provided there is a supply and the price is good, is when now you can buy. So we can help you buy unlisted shares. Startups is via type. Can you explain more about ELS? ELS is equity linked savings schemes. It is under ADC allowed up to 1.5 lakh rupees in ELSs every year. That will be so the money will be locked in for 3 years at least when you invest in ELSs.
Got it. So there's one question from my end. Actually, I just wanted to inquire about SGBs. So is it beneficial to invest in sovereign gold bonds or rather holding physical gold?
Gold is an asset which performs very sporadically. Okay, SGB gives you interest and all that stuff. For all others, SGB stands for sovereign gold bonds. So it gives you interest for the amount you're holding. You can the tenure of holding is 8 years. You can try and exit after. There are two objectives. If your objective is just to save and keep the money aside in gold, SGB is a great option. And then it's also a good hedge. But if you want to play a little more actively on gold, then SGB is not a great option, because if you invest today and if you exit after 3 years, you cannot do that with SGB. So it's a mix of, depending on your objective, SGB may or may not be a good option.
Okay, so we'll just take it up this particular last question and we'll just wrap it up after this. What are the benefits of investing in unlisted shares?
So any company that you invest in, if the growth rates are significant, is what you will make. So for example, if a company that you invested ended up growing by 100% every year, that is what you you're an owner, you're a shareholder, means you're the owner of the company to that extent. So if the company grows at 100%, if you pay the right price, your portfolio also should grow at 100%. In general, unlisted companies are not targeted by a lot of these analysts. The liquidity is poor, the research is poor. So not many people know of it. So they may turn out to be a gem. Unlisted gem is what we call them. So if you can spot someone early, I'll tell you an example. I bought CSK shares at various prices at 35 rupees, maybe 30 rupees, maybe 90 rupees, 170. Today it's at 260. Okay. So if you can spot some good, nice theme, a good unlisted gem, the price can shoot up. Reliance Retail is a company everyone knows. I bought it at 550. Today it's close to 3,500 or 4,000 rupees or so. So you want to invest in CSK, please join the army. I don't support CSK, but I invest in CSK. The point is, these are good unlisted gems. It can happen listed and unlisted, and you can Krishi. Yes, okay. You can sell. Again, you need to have brokers. You need to have intermediaries like us. We will help you to sell it off to somebody else. Just like the way I'm helping you to buy to someone else from someone else, I help you to sell to someone else also. Thanks, 91900. Yes, Tarun, please ask the last question.
Yeah, Anand, just that, I was comparing investments to property. So if in case, if you look at, if someone has invested in property in the year 2005, currently they are at around 5 times. So can we diversify our portfolio, and what are the advantages or disadvantages if we want to? Does it make sense to invest in property, considering the investments nowadays are in excess of 1 CR, and it would require you to take a home loan and pay it up, or using your accumulated funds for paying up 50% and then taking a loan for around 50-60 lakhs. Does it make sense, or one should again go for the other instruments which we have in the market, primarily related to equity?
So 2 parts to it. If you're going to invest, is different. Are you going to stay in that? Is different. If you're going to stay in that, then it makes sense to buy. Okay. There are two. Again, every investment has 2 reasons, right? Qualitative and quantitative. Qualitative means, ghar ke upar, sar ke upar chhat hona is always good. While it absolutely doesn't make sense to own a home, it makes a lot more sense to rent a home, which gives you about you can rent a home at 2.5% yield. 1 crore की property आपको 2.5 lakh रुपए के rent में साल में मिल जाएगा, which means 20-25,000 rupees kind of a rent. So what I'm trying to say here is that logically it is not right to invest in property for growth, but everything is not logic. there are quality reasons also. Your parents may want you to, your wife may want you to, your kid may want you to invest into it. So that's the reason why you do it. Of late, because of availability of other instruments, earlier people used to think only two things, FD and real estate. Now you have a lot of other avenues. So the significance of real estate as an investment itself is bad. And real estate right now is going through a down cycle. I mean, I don't think it is any more down. It can go up from here. But if you're still going to invest in real estate, I think buying a land is better than investing in apartments for rental and all this stuff.
Okay.
Awesome.
Sure.
Thanks, Anand. Thanks, Mohit, and thanks everyone for joining in. For being so patient and helping us out. Thanks a lot, guys. Do share your feedback. We'll be sharing one feedback mail with you. Also, that particular link that Mohit has already shared, we'll be sharing it again with all of you. Those who want to go for a one-on-one session with Mohit or with Anand, they can just register themselves there. And thanks a lot, everyone.
Thank you, guys. You guys were awesome, and looking forward to seeing you also. See you guys.
Thanks,
Thank you, guys.
Have a great weekend. Thanks, Mohit. Thanks, Anand. Thanks a lot.
Thank you, everyone.
Thank you all.